What is the aftershock economy?
Sure. What we're getting at here, and you suggested it in your opening comments, is that we've had massive disruption over the course of the last 4 years or so. Going into that period, we had record low interest rates. I think back in 2019, $18 trillion or so of negative yielding assets, a global pandemic, record stimulus, and inflation. And now over the course of the last 5 quarters, we've had about 500 basis points of central bank tightening. It's beginning to impact the economy. So when we look at the world and look at the types of shocks that we felt the last few years, we think there's going to be volatility ahead. We think we're at a unique time for markets now where there's been a tremendous amount of tightening injected into the system, and you're dealing with the period now where we expect to begin to see the economy slow, certain segments of the economy surprise to the downside. It's going to lead to ongoing volatility. We've experienced it in fixed income. We expect that volatility to work its way into equity markets. And it's going to create some challenges, but also opportunities for end investors.
Well, we'll talk about the opportunities in just a moment. Reading through the piece, fantastic essay, but something stands out for me. You've gone through the differences between now and maybe the pre-pandemic world, yet within the piece there is still a call for a return to target inflation at central banks, including the Federal Reserve here in the United States. There was also a call in there about going back to low real neutral interest rates. What's changed?
That's right. Now, we don't necessarily think we get back to the levels that we saw pre-COVID, but we do think real interest rates will normalize somewhere in that 0 to 1% range, perhaps a bit higher again than what we grew accustomed to for much of the last decade. And inflation, although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target. So again, we are constructive in the sense that we take central banks seriously in terms of their desire to get inflation back towards target. We think eventually they will get inflation back down towards target. But over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. And we're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities across a global opportunity set.
Well, let's talk about those opportunities right now. Where are they for you?
Well, right now we are a bit cautious. As we mentioned earlier, there's about 500 basis points of stimulus that have occurred in record amounts of time. This is an economy where lags are likely longer than they have during prior cycles. The household, as an example, has been able to term out debt at record low levels, fixed rate debt. So they're feeling less of an impact from central bank policy. But trouble is ahead. There's been massive growth in certain segments of the market, private credit, senior secured loans, all of which float to the funds rate, so to speak, and are feeling the full brunt of tightening. So over the next couple of quarters, we do expect to see more signs of an economic slowdown. The good news, of course, is that we've had a massive repricing in fixed income. So we think today, in terms of putting together a portfolio, investors should focus on the public opportunity set, up in quality, and that can mean things like agency mortgage-backed securities that are trading at record-wide spreads. Also, some of the higher quality, more resilient areas of the credit opportunity set. We would be much more reluctant, and we are much more cautious moving into the more economically sensitive areas of the investment opportunity set right now. And that means underweights to loans, underweights to some of the weaker segments of the corporate credit markets.
This is a fixed income house, but within the piece this morning, there is a call on equities. You do make the point that you don't believe that equities have appropriately discounted the world that you're anticipating. What is it you see there?
That's correct. I think starting with volatility, there's been massive volatility in the fixed income markets. You look at implied volatilities in fixed income, they remain quite elevated. Equities have traded very well recently. The VIX index is down again in the 15 handle type range. So we do think that within the equity markets, there's a bit more complacency. We believe as we move forward in time, and this tightening in policy begins to impact the economy with a lag, you are going to begin to see some earnings pressure within the equity markets. You're going to continue to see, and this is going to occur almost in slow motion, continued pressure on corporate credit fundamentals. So as a starting point today, when we look at the fixed income markets, you look at the yields in the front end of the curve where you can put together a high quality portfolio yielding 6, 7, 8%, even slightly higher than that. We think that's a very, very attractive relative return. More cash flow certainty, more predictability. Even historically, that's a very, very attractive return. We think equities at these starting valuations are likely to struggle as we see more signs of an economic slowdown. And I think at that point in time, fixed income not only can provide an attractive yield, but also some price appreciation potential as well.
Within equity markets, there is a big hope and a prayer on AI. And the productivity story around AI perhaps runs counter and against your base case, your central case in a secular outlook, that we could end up with this massive productivity boom. Do you think maybe this, and I'll phrase this question in my way, and you can push back if you deem it appropriate, do you think there is a 150% rally in a single name right now that runs counter to your secular outlook?
Well, we are quite positive on AI as a technology. We've been spending a lot of time thinking about AI and already doing a lot of research in terms of how it can impact our business. And we're optimistic that there could be areas where AI could be quite enhancing from a productivity perspective. So there's certainly going to be winners in the stock market and losers associated with this new technology and the disruptive nature of this technology. Now, as a fixed income investor, disruption is not always a good thing. You better hope you are investing in credits that are not going to be disrupted by this technology. So, we acknowledge this in our research piece, that this is a significant wild card.
Yep.
And if AI gets implemented in a manner that some think it may, this could lead to a sustained period of higher productivity. Of course, there's lots of other factors pushing productivity lower, and even productivity at the economy level isn't necessarily a great thing for financial markets, particularly fixed income, where at best you earn your coupon and you get par back at the end of the day. So the way we're thinking about AI is it's an important technology, it's a disruptive technology. We're assessing its impact from a macro perspective, but even more importantly, very focused on how it may disrupt the companies we invest in, the other business models we support across our business, where again, you better be sure that you're on the right side of the disruption. And again, one of the reasons we do believe that the next few years are going to be much more volatile, more credit losses than we've grown accustomed to, and just more within sector and across sector volatility associated with what we think, at a minimum is going to be highly disruptive. It very well could be the type of game-changing technology that does lead to more sustained higher productivity.
Can we just go through the pockets of risk right now that you are de-risking around? Greg Peters of PGIM was on the program with my colleague Lisa a little bit earlier this morning, and he talked about how some of the risk had moved away from high yield to loans and into private markets. Is that how you feel about where the risk is right now, and are you pulling back from those areas?
Yeah, we agree with that. It's quite remarkable. We were in a very, very low interest rate period for a long time. You end up with a COVID shock where rates hit new lows, and you had households, people with mortgages, significant portions of the investment grade and the high yield universe term their debt out at record low levels and buy themselves multiple years of cushion to deal with a weak economy. On the flip side, two of the fastest growing sectors since the GFC were senior secured loans and private credit. 100% floating rate markets, which made some sense when rates were low and anticipated to never go materially higher. That entire sector today is feeling the full brunt of central bank policy. Those companies are forced to pay higher and higher debt service coverage into what we expect to be a weakening economy. We don't think this is systemic, like the challenges in subprime back pre-GFC, but those are two sectors that are going to be challenged. They really haven't been challenged for a sustained period before. And we do think there's going to be disappointment there. There's going to be losses, the need to restructure debt. Stay away from those sectors today until they reprice. The other factor they have are very, very sticky marks relative to what you get in the public space. But we think this is going to be a phenomenal opportunity for new capital over the course of the next few years. So bottom line, stay defensive today, stay in the IG sector, stay in the high yield sector, but be poised to use some of that liquidity over the course of the next 5 years to take advantage of what are going to be significant challenges within that space. And again, this is moving at very, very slow motion because you don't see the price response like you see in segments of the public opportunity set.
Well, talk to me about what a cash allocation should look like in anticipation of that, and if you can throw it in there too. Are you thinking about a point on the calendar where you think this starts to bite? Because I feel like over the last 12 months, people have made this point and just keep pushing it out. It's going to happen, but maybe next year.
Yeah, so we've looked back at tightening cycles since 1950. And again, a wide range of outcomes during these different periods. But typically it's about 5 quarters before you see the impact from tightening on the broad economy. And we're right at that point today. Again, we've had record amounts of tightening over that 15-month range. So we would expect going into year end and perhaps throughout 2024, steady deterioration in some of these fundamentals. So today, from the cash allocation perspective, we love value in high-quality bonds, particularly bonds priced off of the front of the yield curve. I mentioned earlier, you could stay in very, very liquid, high-quality investments, generate 6, 7%.
Yeah.
Nothing wrong with cash here. I think it's good to make sure you're earning a full yield on your cash. But we think cash makes a lot of sense alongside high-quality bonds. And that gives you the liquidity and the flexibility to shift into what will likely be a very, very attractive opportunity in private credit, in commercial real estate. We didn't talk much about that today, but that's another sector that's moving somewhat in slow motion, but where we expect there to be some challenges and therefore opportunities over the course of the next few years.
In the last 10 minutes, I've heard a lot about being at the front end, liquidity. I've heard a lot about risks on the horizon in the economy for earnings. I've heard very little about taking on more duration. Why am I not hearing that? Why isn't this the moment to buy a 10-year at 370 and anticipate this big Treasury market rally?
Yeah. Well, it's not a bad idea. I think the good news, given the massive repricing in fixed income, is that you don't have to take a tremendous amount of interest rate risk in order to generate attractive returns. I think that may be, a sense of nervousness in the market. Fixed income and duration in general have performed so poorly over the last few years. People are nervous.
Yeah.
But the key point here is that, across Pimco mandates, we're operating near neutral duration across our strategies. In some strategies, even a little bit defensive or underway, and still generating those yields I mentioned earlier, mid to high single-digit type returns, while being able to be a bit insulated or a lot insulated from interest rate risk. So we don't dislike taking on duration here. We just think you can put together a high-quality fixed income portfolio without needing to take a lot of interest rate risk. If we see rates a bit higher from here, if we see signs of further deterioration in the economy, we will look to extend those durations. Our durations are a lot longer today than where they were just a couple of years ago. So we're moving in that direction, but we still want to provide resilient portfolios. Inflation still remains elevated. Central banks continue to be active. So we think there, on the interest rate side, just be a little bit defensive as well. The markets have done the work for us. We finally have value back in the market. Sit back and earn your coupon and get a little bit of appreciation if we end up in a harder landing scenario.
Just a final one from me, Dan, because we've got a whole host of guests in front of us where we can talk about things like commercial real estate and credit. Mark Kiesel coming up a little bit later. What's your conviction trade right now? If you had like a #1 conviction trade, what would it be?
Well, the most attractive asset on the board, at least within the public opportunity set, are agency mortgage-backed securities. They're trading as wide as they did during the COVID crisis. They're wide because interest rate volatility has been high. Everyone's concerned about the Fed selling them, the banks buying less. But you have a high-quality liquid asset trading at an incredibly attractive spread level. Again, a sector that we've been consistently adding across mandates. Not the most exciting trade in the world, but again, we're at a time where there's lots of uncertainty. It provides a steady income with prospects for significant spread tightening if the Fed begins to get closer to their terminal rate this cycle, and we begin to see volatility come down. So that would be our best opportunity within the public space.